Palantir sits at a crossroads that most AI investors sidestep rather than confront. The consensus framing is simple. Government AI contracts are accelerating. Palantir has the data integration architecture that defense agencies actually trust, and the commercial segment is beginning to compound. That story is not wrong, but it is incomplete in a way that matters enormously for anyone trying to assess risk. The company trades at a multiple that assumes the defense AI build-out proceeds at scale, that Palantir captures a disproportionate share of it, and that its commercial momentum does not stall. All three conditions would need to hold simultaneously. When you price a stock for a trifecta of favorable outcomes, you are not investing in a thesis. You are betting on its execution, without margin for error. What makes this harder to dismiss than the usual growth stock valuation debate is the broader context. NVIDIA's forward price-to-earnings multiple recently fell to parity with the S&P 500 for the first time in over a decade. Goldman Sachs flagged the disconnect. NVIDIA is projected to account for roughly 21% of the S&P 500's total earnings growth in 2026, yet the market stopped paying a premium for that contribution. If the market is repricing the most structurally important hardware company in AI at index parity, the question is obvious. What does that repricing imply for a software company whose defense contracts are long in duration but narrow in breadth? The answer is not that Palantir is wrong. The answer is that the valuation assumes a certainty that the broader AI market is no longer granting to anyone. The standard pitch for Palantir's defense relevance centers on Gotham, its government analytics platform, and the more recent AIP, the artificial intelligence platform, which layers large language model capabilities onto operational data. The pitch lands well in investor presentations. It lands differently when examined against the structural demands of actual defense AI deployment. Defense AI is not a single category. It spans battlefield decision support, logistics optimization, signals intelligence, autonomous systems coordination, and classified data fusion. Each of those use cases carries different procurement timelines, different classification requirements, and different integration dependencies. Palantir has demonstrated genuine capability in the analytics and data fusion layers. The question that the valuation does not seem to price is whether that capability translates into the recurring, expanding revenue base that the multiple demands. Here is the part most observers miss. The largest threat to Palantir's defense positioning is not a competitor with better software. It is the Pentagon's own fragmented procurement structure. Defense programs operate on multi-year budget cycles with congressional approval gates. A platform that proves its value in one program office does not automatically expand to adjacent ones. The internal selling motion inside defense bureaucracies is slower and more political than commercial enterprise sales. Palantir has navigated this before, but the current valuation implies a velocity of expansion that the procurement architecture may structurally resist. Meanwhile, the AI infrastructure layer beneath defense deployments is shifting. NVIDIA's NVLink fusion expansion, embedding its networking architecture into third-party silicon, is creating a more flexible, distributed compute fabric. Amazon's Trainium chips are gaining traction in cloud AI workloads. The hardware layer that defense AI runs on is becoming more competitive and more customizable. That should benefit application layer companies like Palantir, but only if they can move fast enough to integrate with evolving infrastructure before agencies build internal capability on top of it directly. The bear case on Palantir is well rehearsed. Valuation is stretched. Revenue concentration in government creates dependency on political budget cycles. Commercial growth, while accelerating, is building from a small base. The stock has drawn comparisons to other enterprise software names that carry defense narratives without the underlying revenue durability to match.
That is all true, but here is the reversal that most of that analysis overlooks. Palantir is not primarily selling software licenses. It is selling operational ontology, a structured framework for how an organization understands and acts on its own data. That is a fundamentally different product than a database or an analytics dashboard. Once an agency builds its decision-making workflows on top of Palantir's data model, the switching cost is not the cost of replacing software. It is the cost of reteaching an institution how to understand itself. That lock-in is not theoretical. It is the reason Palantir has retained government customers through administration changes, budget cycles, and multiple technology generations. The commercial acceleration matters for a related reason. The same ontological architecture that creates lock-in in defense is beginning to resonate with large industrial and financial enterprises managing complex operational data. Palantir's U.S. commercial revenue has been growing faster than its government segment. If that trend sustains, the company's valuation case shifts from defense concentration risk to cross-sector platform durability. That is a meaningfully different risk profile. The broader AI infrastructure news reinforces the environment. NVIDIA's $2 billion investment in Marvel, aimed at embedding NVLink into third-party silicon ecosystems, signals that the hyperscalers and chipmakers are converging on interoperability as the next competitive layer. For a platform company like Palantir, a more interoperable infrastructure stack lowers the integration cost of deploying AIP across diverse customer environments. That is not a headline, but it is a structural tailwind that compounds quietly. The upside scenario does not require Palantir to win every defense contract. It requires the company to become the default data ontology layer across a meaningful subset of Five Eyes defense infrastructure, while simultaneously compounding its commercial base at current rates. If both conditions hold through the next 2 to 3 budget cycles, the current valuation becomes defensible on forward earnings rather than speculative multiple expansion. The downside scenario does not require a competitor to defeat Palantir directly. It requires the Pentagon's fragmented procurement to slow the expansion velocity, while commercial growth plateaus as larger enterprise players build comparable ontological frameworks on top of existing data stacks. In that scenario, the stock's multiple compresses even if revenue continues growing, because the growth rate fails to justify the implied terminal value. The recovery path from the downside is real. Geopolitical pressure is not easing. NATO countries are increasing defense spending. The demand for AI-enabled decision support and multi-domain operations is structural, not cyclical. If Palantir navigates the procurement friction and lands 2 or 3 major platform expansions in allied defense ministries, the narrative shifts from concentrated U.S. dependency to distributed Western infrastructure. That would reopen the multiple. One additional pressure point deserves attention. Tesla's brand erosion in key markets and Amazon's recent AI chip leadership departures are both signals of how quickly organizational coherence can fray during periods of aggressive expansion. Palantir is expanding aggressively across both government and commercial sectors simultaneously. The operational risk of that dual-track motion is real, and it is not reflected in the valuation. The evidence warrants toward Palantir having a genuine structural advantage that its competitors cannot replicate quickly, but that advantage is priced for near-perfect execution. The more measured read is that the company is a legitimate infrastructure candidate for defense AI, but only if procurement velocity matches the ambition the market has already paid for. If that condition holds, the current multiple may prove reasonable in 3 years. If it does not, the correction will not be gentle.